Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at Signature FD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. We are back with another episode of the Vet Worthwhile podcast, first of 2025. We are super excited to welcome my good friend, Signature FD's Chief Investment Officer, who's a recurring guest on the show, Tony Welch. Tony, welcome to the show.
Hey, thanks for having me again, and Happy New Year to you guys.
Awesome. Happy New Year to you as well. Travis, how are you doing? You're back. You made it. You survived your annual trip to the great north of Iowa. You made it back south.
Survived 45 hours in the car and back and ready to go for 2025, and super excited about catching up with Tony. I mean, I think there's just all kinds of interesting stuff going on at macro level, and helping veterinarians understand how it impacts or ties directly to their world is probably one of the most exciting episodes we've had in a long time.
Yeah, I think so. I feel like we're at a pivotal moment here. I mean, not only with just the obvious change in leadership from the election, but just where we're at from a financial market, from an economy, small business owners. I mean, I feel like we're at some sort of inflection point where we're going to see some changes here. But before we dig into that, Tony, let's talk first, just a high level recap of 2024 from your perspective. I feel like it's always good to kind of set the table with what has happened most recently before we start to prognosticate on the future. So what do you have to say about 2024?
Yeah, I mean, 2024, another really strong year, especially for the mega cap stocks in the U.S. The S&P 500 index added 25% on a total return basis. So strong year, and it was really driven by an economy that was kind of gaining steam throughout the year, which was contrary to economists' expectations. We saw momentum really picking up throughout the year, and it looks like we actually ended 2024 on kind of a high note from an economic perspective. And typically when you get that combination of strengthening economic growth, and as long as inflation is stable and not really kind of getting out of control, that's a potent mix for investors. And last year was really no different. So, a lot of that economic momentum that's being driven by service spending and all throughout the year. And that's continued to be the case.
Yeah.
Tony, so you jumped off, and I mean, I don't mean to dive in right away into tough questions, right? But you live in kind of the investor world, right? Like, what does the market do? What do the investors want to do? What are how much dry powder is sitting, like all these different factors, right? Like for guys like me, like that's just some stuff that used to show up in the newsprint of the Wall Street Journal. And now I click on Yahoo, right? Like more Main Street, right? Like we're dealing with Main Street business owners. Am I right that there's like this disconnect between like what Main Street feels and what New York and Wall Street report? And what's driving that? And not to throw you a hard one right out of the gate, I should start you with a softball, but like, what does that look like, and why is that?
I mean, it sounds like a hard ball, but there's actually a really easy answer. So when you think about inflation, right, and we look at the small business surveys to say, what's your biggest problem, right? And they say their biggest problems are labor, quality and availability, and then inflation. And if you go look at consumers and you say, what's your biggest problem in the world right now? They say it's inflation. Well, inflation in 2024 ran below a 3% rate. We actually just got the latest reading, and it was 2.9% year over year, which is manageable inflation. The problem is all the crazy amounts of inflation we had in 2021, 2022. And so the consumer sentiment, you can kind of think of, it takes like 4 or 5 years for people to adjust to a level change like they saw in 21, 22. And their sentiment is still quite negative around what the economic backdrop is, what they're paying on a level price basis for things. And so there's still just that sticker shock, and that takes time to work its way through the system. So as long as that kind of rate of inflation can remain controlled over the next coming years, then consumers will start to adjust to those levels, and I suspect confidence will start to return.
Yeah, I mean, also like just what's happened with inflation being higher, the level cost of all things is higher and not likely going back down. And financial assets have done well, obviously, but most people, the working people, they're not monetizing the equity in their house. They're not cashing in their 401ks. So maybe their incomes have kept up with the higher prices. Maybe they haven't. Either way, it doesn't feel good when you're buying eggs that are 50% higher than they were 2 years ago. It's just psychologically, it doesn't ever feel good. So hopefully, like you said, Tony, that starts to turn around with respect to consumer confidence, but very interesting nonetheless. So you touched a little bit on inflation and where we're at now. I think it'd be good to, maybe dig a little bit deeper and talk about where we're at now. What are the areas under the surface that are more sticky? And then how is the Fed looking at this? Because for us who play in, obviously we spend a ton of time with this, stock market investing, and the volatility over the past few weeks, given certain like jobs reports will come out that are positive, but that'll have an adverse impact on the view of the trajectory of Fed policy. So where are we at now on inflation, and what do you think the Fed is looking at most specifically?
Yeah, I mean, inflation is kind of stabilized at a rate that's going to be north of 2%, but probably less than 3.3, 3.5%. And that is okay. That's manageable. But what it means for Fed policy is probably not going to be as loose as people were anticipating going into the kind of the initial rate cut. And you're starting to see that it's in the long-term interest rates, James. You've probably noticed that they started rising after the Fed's first interest rate cut in September. And then that accelerated after the election. And so what's going on? What's going on with long-term interest rates? Well, the bond market is pricing in, one, that the Fed's not going to cut as much in the future. And why is that? It's because inflation's a little bit stickier and economic growth is also settling in at a little bit higher of a level. And that's all just getting repriced right now. The sticky components of inflation are areas that are actually like shelter. Shelter costs have been sticky. Insurance, automotive, health insurance, those things have been sticky because those are all playing catch up to prior inflation. So that's kind of the places that have been sticky. But we've generally seen improvement across most of the rest of the inflation basket.
And I think that's super important, like for just the economy right now and where we're headed into 2025, like understanding the disconnect between short-term and long-term rates and what type of things are priced on different type of rates. Like specifically in vet, as hospital owners are considering partnering up with a corporate group that has private equity funding, like those rates that those companies borrow at are generally based on the short-term rates, whereas their mortgages that they're getting on their personal residence or whatever is based on long-term rates. And those two are moving in opposite directions. And I think that's confusing for a lot of people. So, it's definitely something to keep an eye on and to look at. What are we seeing from the broader economic picture? Like 2 years ago in 23, when the Fed had started increasing rates, inflation was high but falling. I mean, my recollection was like 95% of economists were saying recession in 2023. Obviously, that didn't happen. 2024, we did not have a recession. As you mentioned earlier, it was actually pretty healthy growth net of inflation. What are we looking at for 2025, and what are you seeing in the spending numbers?
So from that perspective, I have somewhat downbeat news, but it doesn't have to be all bad. The economy is likely to downshift in 2025. So if you consider that in 2024, we grew about 3% net of inflation, that's actually a really strong number for the U.S. economy. The U.S. economy should grow about 2% at steady state. So consider we were doing 50% better growth last year than steady state growth. We're likely to downshift. Now, what's going to drive that? And why is this important for vets, right? Is the reason that growth is probably going to downshift is because real incomes are probably going to downshift. So last year, wages net of inflation grew 3%. What did the economy do? 3%. This year, I expect wages to continue to ease and not fall off the cliff or anything. But what we're seeing in the labor market data is we're seeing that companies are hiring less. So the so-called hire rate is going down. People are feeling that. They know intuitively that there's less hiring going on and they can't just walk across the street and get a new job. So what are they doing? They're quitting less. So the so-called quit rate has also fallen. And that's a measure of kind of worker confidence. You don't quit your job if you're not confident that you're going to find a new job. So hire rates are down, quit rates are down. And what tends to happen when those two rates are falling is wage growth eases. Now, the risk is that inflation remains steady at this roughly 3% rate. And so you start to compress the difference between the new wages that people are making and the inflation they're dealing with. And that kind of excess there is what you can expect for economic growth. So last year, we got 3% real wage gains. This year, I expect that to downshift to something like 1.5%, 2%. And so I do expect the economy to downshift this year.
So kind of leaning into that a little bit, like this tightening. And I mean, I think there's a couple things I'd love to have you talk a little bit more about in there, Tony, is one, I mean, you were talking about the 3% inflation rate in 2024, but like that's assuming that the massive inflation that occurred in 2021 and 2022, wages had already caught up on, right? So like that to me feels like a huge like potential stress or strain because, I mean, my half gallon of milk that we go through like 10 of them a week with 3 boys in my house used to be, $3.50 and now you walk into the store and, it's $5, right? Like I think that that's real. So, I'd love to have you kind of talk a little bit about just that catch up on the massive inflation we experienced, but then also, maybe taking it more to the vet level, talk about jobs numbers and what's happening in the overall labor market. I mean, because I think I can kind of speak just, from what I'm hearing, it really does feel like the labor market is loosening up in the veterinary space. And is that just veterinary or is that, across the board? And especially inside of veterinarians, right? Like hiring a veterinarian now, you may have an application for a role that you don't have.
I think that is so astute, Travis. I mean, if the reality is that historically, food, energy prices, those are swing factors in the inflation bucket. They're a lot less stable. They're more volatile. And people need those things. You need your half gallon of milk and you need to get to your office and what have you. And so that represents risks, right? If those things continue to move higher, then people and their wages aren't keeping up, they're going to have to make more difficult decisions. Now, fortunately, me being a pet owner myself, I can tell you that that's one of the last difficult decisions I drop is we do what we need to take care of our pets. They're members of the family. But yes, people need to start making difficult choices when that's the case. And then on the jobs numbers, that's pretty much economy-wide. We've seen loosening throughout the whole labor market, probably less loosening actually in health and professional services than some other areas. You take a look at something like manufacturing and boy, there's been a lot of loosening there, so it could be worse from a loosening perspective. But now the counterbalance has been technology, right? We are in something of an AI boom. So that's still a fairly tight labor market. But yes, those are all really great points.
So you raised something, and this may just be like too minuscule to even affect macro things, right? But you said something that in 2021 didn't happen. The cost of getting to work. Is that going to be the fact that now almost everybody is going back to an office, right? I mean, we live in Atlanta. I experience it every day, right? Like Atlanta feels more and more like LA every time you get on the roads. And I think that has to do with the fact that people now have to get back to work. Is that cost of getting to work going to impact anything on a macro level, Tony?
Yes, on the margins, it will affect consumer sentiment, and on the margins, it will result in a little more consumer spend if we do see those things. Now, keep in mind that we do have a new administration coming in who's focused on drill, baby, drill. So, not sure what's going to happen from a energy perspective in the upcoming year. But yes, those things do tend to, I would say, more impact psychology than anything else. When I go back and look at when energy was a real actual drag on economic growth, you've got to go back into the 70s, 80s when people just comparatively spent so much more on energy. I don't know about you guys, but I drive a minivan and a car that get 35 miles to the gallon each. It's just quite a different story than my dad's Camaro that got 11 miles to the gallon, back in the day. So that's just an anecdote to say we're far less energy intense than we ever used to be, but that doesn't mean it doesn't affect psychology.
Yeah. I mean, it's the price of oil is down 20% over the past decade, and cars have become significantly more fuel efficient. So, I don't know if that would have truly kept up with other inflation measures, especially when you think about like healthcare and education and that kind of that has absolutely gone up and to the right, and it's been tough. So Tony, the majority of our listeners own a small business. I mean, they're obviously doctors and they're clinicians at the heart, but they're also small business owners. And we've talked about a lot of these things that impact them: borrowing, lending, the economy, jobs. What kind of data are we seeing from our indicators we look at with respect to small businesses?
I mean, activity is still not great, right? Top line revenue at small businesses writ large. So, this is more broad based, and there could be different things going on at the vet level. But top line is not super strong for small businesses. Earnings have been downright weak. And the reality is like I said, they were feeling more a brunt of labor inflation than the huge cash cow, large cap companies that people could invest in. They were feeling issues with labor. They were feeling issues with input costs, and profit margins just really haven't expanded for small businesses yet. And that explains a lot of why you had this economy humming along, but small business owners did not feel positive for the last several years, and for good reason. Now, one of the most fascinating developments is, in fact, the election. So following the election, we got 2 readings on small business expectations, and they've absolutely gone through the moon. So small business owners are expecting a better environment going forward. Now, whether that actually comes to pass or not, we'll see. But the expectation is definitely more positive than it's been at any time in the last several years.
Tony, do you have any insight on what's driving that? Is it reduced regulation? Is it lower borrowing rates? What change is driving that increased confidence?
Yeah, I think it has to do with a couple things. One, small businesses don't want regulation. I mean, I think deregulation is a good backdrop for small businesses. So that helps. And I also think that they know what they've experienced the last 4 years, and their expectation is that's going to change. And again, it has to be seen that will change, but the expectation is it can't get worse than it's been over the last 4 years, and hopefully we get some positive changes going forward.
Yeah, it'll be interesting to see how that comes out. I was looking at a portfolio recently, Tony. Well, let's just say that the client had a large concentration in energy as a result of drill, baby, drill, which you hinted at. And when I talk about a large concentration, I mean like 35% of their equity portfolio, which was obviously alarming. And I had to show them what the worst performing sector was the last Trump administration, and it was relative to the S&P, and it was energy. It wasn't even close. So I think there's a misunderstanding about disconnecting industry and economic activity from the stock market. They're not always going in lockstep, and I think people just need to kind of tread carefully before they put all their eggs in one basket in general.
So that brings me to, and I know we want to focus on the things that are most impactful to vets, but I will say that Signature FD, our investment strategy for the year is one of rebalancing and diversification. For a lot of these reasons, is you've had some obscene winners over the last 4 or 5 years, and it's mentally challenging to rebalance from those things to the things that haven't worked quite as well. But at some point, you need to think about that and think about, taking some gains and going to some areas that haven't worked quite as well. So that's just one PSA I would throw out there to all investors.
Yeah. And I think that's helpful. One of the things we wanted to touch on with you, Tony, because, we have our own private equity fund structure, and obviously our team does a ton of research into it. And it's been a challenging year, challenging few years in private equity, given where interest rates went and volumes are and the amount of dry powder that's there, borrowing costs have increased, et cetera. What do you think is going to happen going forward? Like, what are you hearing from all the good folks that we work with? And from the lens of most of our listeners will be considering a partnership with some sort of private equity backed corporate group. And so, as a future partner, as a seller or whatever, what's the landscape for 2025?
Yeah. So, we constantly reach out to managers that we work with, and with a caveat that Signature FD we're not specific deal people ourselves. So this is where, I just want to kind of add that caveat. But what we are starting to see some unthawing of the private markets. I think the shock of higher interest rates and the shock of how much private equity was paying and valuing businesses back in 2021, 2022, and just the sheer massive amount of capital that private companies raised, or that private equity companies raised to deploy. That is, you think about a rat making its way through a snake, right? It takes time for that stuff to work through the system. And by the end of 2024, we did start to see a little more buyout activity. We did start to see IPOs moving a bit higher, but from a very low level, right? We did start to see exit values off of their lows, right? So you're just getting this gradual unthawing. And I think that my biggest thing that I would point to is you really need to look at private markets pre-pandemic for an expectation of where we're going to go in the future. Because 2021 and 2022 were obscene outliers for private equity. And that is just an environment that we may not see again. So you really need to think about what were EBITDA multiples pre-pandemic? What was the activity like pre-pandemic? When you're trying to frame out what the outlook is for private equity going forward.
So kind of just to take that like a step further and maybe try to start to dig in and unpack a little bit in the vet space, right? Like pre-pandemic, we were seeing veterinary hospitals trade for 8 to 12 times earnings. In 2021, we started to see individual hospitals getting valuations. Again, there's some deal structure and some nuance to that, but let's just shoot big here, Tony. Individual hospitals were getting 18 to 20. You had hospital platforms trading at 23. I can remember sitting in a meeting in June of 2021, which was like the first, in-person, masked up post-pandemic. And one of the analysts that was doing that said, these platforms are going to trade for 28 times, 30 times earnings. That's what veterinary hospitals are going to be trading at, right? Like, those are not normal multiples in the world that you live in. Can you maybe help just level set? What do service type businesses normally trade for an individual? I mean, maybe individual isn't a fair ask of you, but what do normal businesses trade for that are service based in the platform realm?
I mean, it's exactly what you just said. It's high single digit to low digit, double digit multiples. And that's what you can kind of expect. And boy, when I hear you say numbers in the upper 20s, that's insane, and congratulations to anybody that monetized at those levels. But definitely, I think more normalcy is what you were describing, Travis.
We touched on deregulation, but that means a lot of different things to a lot of people. One of the things that I think is going to be a theme going forward is just, and this has been an issue in the vet world specifically, is the FTC coming in to stop deals from being done in specific areas, specifically in emergency specialty. But, we've heard rumblings that could even happen with general practices as well. And this is like, what are our thoughts? What are your thoughts, Tony, on the broader M&A under Trump 2.0 relative to Biden? Because it seems from everything that I'm reading that people are starting to get more optimistic that they're going to be able to get more deals done just from a clearance standpoint. I don't know if you're seeing some of the same stuff.
Yeah, absolutely, James. I think that's probably going to be the case. And for smaller businesses, I think that's almost certainly going to be the case. We have to remember that Trump is populist at heart. So, you might see some splashy, really large mergers still face headwinds. But I think on net, you're absolutely right. You will likely see less of a burden on smaller M&A activity.
I think that's overall a positive step because, several of the veterinarians that I talk to are trying to find that partnership and getting pushback even just from a sale of an individual hospital into a broader group. And we're not even talking about a group and a group coming together. So I think that could be a real big positive for a lot of our listeners.
Certainly.
Tony, last question, which I think we should have probably put this at the top, super important. What are your thoughts on Florida State's trajectory as a football program?
Well, I come at that much like a small business owner, James, where I just don't think it can get more difficult for us. So, I think the trajectory can only go one direction from here. So I'm optimistic that better days are ahead of us.
I may remind James, when you live in a glass house and you just lost your starting quarterback to Miami, you got to be careful casting stones.
Let's just say not all of us were sad to see that happen for reasons I won't get into on this beautiful PG podcast that we have here. But we shall see. I think it's exciting. I can't wait to hear, Tony, the Harvard business study on them getting left out of that playoff and the ripple effects it's had over the following decade, because it's just going to be unbelievable, the effects that had on the program. And if I were them, I would be very upset still.
Well, listen, I can say that my Saturdays had never been more free and clear in my life. So, at least the glass was half full from that perspective.
Yeah, you can focus on what really matters, making sure your kids' baseball teams go undefeated.
Indeed.
There you go. Well, awesome. Tony, thanks again for jumping on, man. We really appreciate you coming in, and everybody loves your insights and just kind of helping to set the table for what we should expect to see in 2025. So thank you for coming on, Travis. It's good to see you again. I'm sure we'll be connecting here in the next few weeks on another episode. So we'll send off with that. It's been another episode of the Vet Worthwhile podcast. Everybody have a good day. See you next time. Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signatureveterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content, and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of Signature FD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which Signature FD has no involvement or ownership. James Yost is a partner and wealth advisor at Signature FD. Signature FD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and Signature FD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.